now that we've looked at all of the classes of ICOs that happen and the total amount that have been offered over the last year, there's a simple question that we have to ask ourselves: is a token or are coins securities? And here's something that Jay Clayton said just a few weeks ago when he was giving testimony to Congress or to the Senate. He said, "I believe every ICO I've seen is a security. ICOs that are securities offerings, we should regulate them like we regulated securities offerings." End of story. And then just before that, he said, "I have asked the SEC's Division of Enforcement to continue to police this area vigorously and recommend enforcement actions against those that conduct initial coin offerings in violation of the federal securities laws." So as far as the SEC is concerned, this is a very clear case. It is a security. Now, what is a security? Well, it goes basically back to the so-called Howey test, where the SEC had a case run against W.J. Howey Corporation. So the idea is an instrument is a security if it involves an investment of money or other tangible or definable consideration used in a common enterprise. So it could be bonds or whatever other means of payment you can think about. And here it's important, with reasonable expectation of profits to be derived primarily from the entrepreneurial or managerial efforts of others. So you give money to somebody else and you expect the benefit of it without doing anything yourself. So when you have a note from a furniture store to finance a customer's purchase, that's not a security because the purpose here is to facilitate the purchase. However, when you have notes issued by a corporation for the general use of the company, then the buyer will be primarily interested in the economic gain from the entrepreneurial effort of others, and that is a security. The exact form of it, so whether it's called a formal certificate, a normal interest in the physical assets, or for that matter, a coin, a digital coin or blockchain item, that is totally irrelevant to whether or not it is a security. Now, let's not get stuck with the regulator's view of the SEC. They are overzealous, if you ask me, and they are, often acting in a relatively aggressive manner without sometimes, for me, it's often not clear why they are so aggressive about their behavior. But anyway, here we are. In the US, I should mention that, for instance, Bitcoin is also regulated by the CFTC because they believe it is a commodity. So now let's like to look at what the Swiss regulator is doing, because as you saw from the pictures before, Switzerland has a very large number of ICOs. So their regulation has the following mandate. They want to ensure that market participants can base their decisions regarding investments on reliable and defined set of information, and trading should be fair, reliable, and offer efficient price formation. The legal standards that they have is that's a standardized certificated or uncertificated securities, derivatives, and intermediated securities that are then suitable for mass standardized trading and are publicly offered for sale in the same structure and denomination. So that's basically what, this is something that is in the area of interest. If this is whatever it is that you want to issue falls under these premises, they will look at it. Now, they have made a differentiation, however, between three different types of tokens. Number one, they're payment tokens. So those are synonymous with cryptocurrencies. The intended use for these is now and in the future only as a means of payment for acquiring goods and services, or as a means of value transfer. These give no rise for claims on the issuer. Keep that in mind. Ether does not give you a claim on anything that relates to Ethereum, the Ethereum network. Same for Bitcoin. Then they have utility tokens. The intended use there is to provide access digitally to an application or service by means of a blockchain-based infrastructure. And then third, there's the asset token. So that's a debt or equity claim on the issuer. Asset tokens promise a share in the company, voting rights, future capital flows, and there's an economic function, which is analogous to that of equities, bonds, and derivatives. Also, tokens that enable physical assets to be traded on the blockchain also count as securities. So, for instance, if you think of tokens on the deeds of your car, that would be a security as far as they're concerned. So now, What is their view in terms of whether or not they are securities? Payment tokens they treat as money, which in their view is not a security. Utility, if this is only being used to pay for an application or service, that's not a security. If additionally or only there has an investment purpose at the point of issue, then it is treated as a security. And then finally, there are asset tokens. Those will always be treated as a security. Now here's the part where it gets interesting. If you have the pre-financing and pre-sale phases of an ICO, sometimes you have tokens that confer claims to get future coins. And if that is the case for the particular token that you're issuing, then that is also a security. Now, this is important because many ICOs work precisely in this manner. And we're going to see an example in a minute. Now, there's also some secondary features and secondary considerations. For instance, if you're underwriting or offering third parties tokens, then that's a licensed activity and you must become a broker-dealer. So now, of course, the entire premise of blockchain-based financing is you take the middleman out. But if you do want to become an intermediary there, a middleman, then you have to register as, as a broker-dealer. Next thing is if you issue tokens with interest-like return promise, then you basically take deposits and then you must obtain a bank license. And finally, if you maintain payment services, so if this is part of what you're dealing with, then you also have to be subject to anti-money laundering regulations. That, however, does not apply if you have utility tokens. All right, now here's the considerations for Canada. The above, and what I would argue the reasonable approach is based in Switzerland. In Canada, if you want to legally run an ICO and you want to reach a large group of investors and have it tradable thereafter, then you either need to abide by the strict offering rules or you target only accredited investors. So what you would do then is you access the exempt market with an exempt market offering memorandum. So this is something we talked about earlier. Or you can try to avoid Canadians and Americans and hope that your coin does not get classified as a security. Which brings me to case study number 1, Kinny. Now this is an ICO that closed last year as one of the largest at the time. It is a token for yet to be issued coin. So this is by the regulation of the Swiss regulator, is you just bought a token, which is a claim on some future coin that comes your way. So even by the lax laws of the Swiss regulator, this is a security. They're issued by a company called Kick. Now, you may or may not have heard about them. I have not heard about them, but apparently they are pretty successful. They were very successful. The company was actually the team that had developed the BlackBerry Messenger, and BlackBerry eventually spun them out and let them go by themselves. And they're doing quite well, but then eventually Facebook started operating its own messenger, at which point they couldn't compete anymore. Now, that had a pretty unique business model. And what they did was that people could unlock certain features of their chat service, stickers and other things, when they would watch, videos, take surveys, watch ads, and so on. So, there was an interesting business model, and what they wanted to do is they wanted to grow the ecosystem and incentivize developers in particular. So what they did is they issued a total of about $90 million worth of these tokens. But if you look at the entire valuation, that basically gave rise to a valuation of this network of 1.25 billion. Here's the total valuation. If you ask me, and this is a very large valuation for this very small company for over a very short period of time. Essentially looking at a user base of not even a few 100,000 users, actually a few million users, but even that is nothing compared to a Facebook and the like. So now there was a comment that I saw on Medium about this, is that everything Kik wants to do can be accomplished with fiat currency or a simple payment integration within their app. And that's the thing, right? So as is often the case when you have these issues of coins, there's really no need for this particular coin. There's no explanation why you need it. You could just use money. And I met with people from Kik multiple times, and I kept asking the same question: why can you not just use money? And they wanted to use this as a prepayment method. And so that can basically print their own money to reward developers. Well, we'll see how it works out. The next case study I want to bring you to is TokenFunda. It's also a Canadian firm. It's an ICO that is currently running. Their coin is essentially as a security, and they market it as such. So they have asked for an exempt offering memorandum from the OSC Launchpad, and they are using the exempt market. So they're targeting either accredited investors, or they also try to target the crowdfunding market, and they apply the crowdfunding rules. And this will be the first legal asset ICO in Canada. Now in the US, there's something called the ZAFT protocol. Now the premise here is that their view was that a utility or payment token is not a security once it is in operation. So once you issued something like a cryptocurrency, then it is not a security. Before you operate it, it could, however, be a security. So the idea here is that you want to have that they develop this simple agreement for future tokens, or abbreviated as SAFT. So what they wanted to do is they wanted to limit the investor base before the token was usable to only accredited investors. And they were doing this using a forward contract. And there's now a new team of a firm called Harbor. What they're trying to do is they're trying to have a blockchain-based system where you basically have an on-chain regulator that allows only the usage of registered addresses that are associated with accredited investors. And that would then give rise to them being able to raise the funding from accredited investors while the utility token is not in operation. There's the regulation in the US is called Reg D, essentially. Now, let's just think for a second, why would you want to do an ICO? What is it that you cannot get elsewhere? So one thing is you can basically get verification for the entrepreneur's vision, right? But every time, so in the traditional financing world, what you do is you have venture capitalists, you pitch to a venture capitalist. These are guys that have a lot of experience, and they will basically tell you if they think that there is a market for the entrepreneur or not. Now, the crypto world, that's a tricky part because, venture capitalists don't have the expertise, they have no experience in this. And, it's not really very clear whether or not these tokens will work out or not. So what you can do is you can use the appetite of crypto asset or crypto security investors as a benchmark for whether or not you believe, or these folks that are usually plugged into the ecosystem believe that this is potentially a useful product. So like crowdfunding, you can actually learn the product demand. The commissions, of course, are much lower. Essentially, when you access your investor base directly, you don't have to pay the humongous fees that you have to pay when you do an IPO. Of course, an IPO is not the right level of comparison because this is really very early funding for very early companies. You can also have extremely small minimum investment amounts, so you can have a huge investor base. And as they are structured, these investors don't have a say. They don't manage your board of directors. So whether or not you have 1 million of them or one, it makes little difference to you. You have access to a global investor base, particularly because you can allow small investments, and your tokens are readily tradable. So you immediately have an aftermarket for your coin, which of course from a regulatory perspective is a huge problem because these coins are not supposed to be traded. In particular, even if you want to go with only accredited investors, it's really almost impossible to, unless you build in, well, it's not possible, but you have to build in extra provisions to prevent regular people to get their hands on your tokens. There are other things you can do here. You can have pre-program, for instance, a term sheet, so that given a certain set of benchmarks, more money will be released for you. You can have contingent fundraising. There's many different things that you can do here. TokenFunda has a very nice graph on their website where you can see essentially that between the investor and the business, usually they're brokers, banks, exchanges, central registries, and clearinghouses, and so on and so forth. And all of that is essentially gone. And quite honestly, I cannot see a world in which this funding model in some form or another will not take over. And in the process, it will eliminate most brokers and the the brokerage arms of major banks. There is no other way. Now let's think about a few small other things about this. What are common features of ICOs? There are many different sales mechanisms. There are auctions have been used. There are staggered sales where the price is fixed but rises from phase to phase. There are periodic auctions that run over multiple months. People have experimented with a large number of different sales mechanisms there. But usually it all boils down to the same thing. An individual sends money to a smart contract and hopes for a distribution of tokens thereafter. Now, often what you do is in these token offerings is you do buy a token that will then be exchanged at some future date into a coin that you can use to buy a particular product or service. And often the token will involve the establishment of a foundation that would manage future token issuance. Now, the issue here is, and this is something which I don't want to go into all the details with, but there's always a potential a conflict of interest between a firm that manages, say, a platform and token holders. So the equity holders of the firm and the token holders of the firm may have opposing needs and opposing interests. And putting a foundation in between that essentially has a governance mandate can, maybe able to alleviate some of the problems. The problem is that these foundations are often located in low-touch regulatory environments, so it's not really clear what they could actually do. Now let's think about a few considerations going back to the economics of ICOs. There's very little analytical work that I know of. So one paper has been circulated on March 11, 2018, so not even 2 weeks ago, where they set up this offer. The ICO is a 3-stage process. There's an offer process, then there's the interaction, and then there's a possible new issuance of tokens. In their paper, an ICO is essentially a pre-sale mechanism in which you learn the demand for your product. That in itself is taken essentially from crowdfunding papers. There are others that model it in the same way. What they also have is that there's a possible monetary policy, which in this particular case is just the issuance of future tokens should the ICO be successful or not. So the results that they have is, not surprising, that the crypto tokens reveal consumer demand, and sometimes the returns when you use crypto tokens exceeds that of what the entrepreneur could earn from normal equity financing. It's kind of would imagine that comes from the first point. And they also show that a lack of commitment in monetary policy can undermine the savings of ICO investors. Finally, if you want to delve into this a little more, you should think about, what is an ICO really? Well, ICO oftentimes is you have a system, you have services, and you use the token as a payment mechanism within your platform. And now the funny thing is that within a platform, people don't earn their salary, right? So if I go into a platform, and for most people who want to use a service, they still earn their labor income in US dollars, Canadian dollars, or who knows, maybe at some point in Ether even, right? So, but the point is that you have these ecosystems where there's a particular payment mechanism, and every time you want to make a payment, you have to get these coins, as opposed to using the standard unit of a coin. In other words, the means of payment and the units of a coin differ. So from an economic perspective, that seems to be an important feature of it. And that means that monetary policy matters, right? So the amount of money that you have in the system, like savings levels, price levels, speculation, and the goods market production. So monetary policy and monetary theory here is just as relevant as corporate finance. And that's something that yours truly is working on.